Recession or not, here I come. Hey everyone, me Kevin here. In this video, I'm going to give you the exact details of what I think about the market where we are now, whether I think it's buy time or sell time, and I'm also going to tell you about exactly what's going on with my portfolio, whether it's stocks or real estate. Now, every time I make a move, you all know that every one of my moves is broadcast first to my course members in either our private live streams or via alerts that I send, and you get lifetime access to those programs when you join. And you want to join now before July 28th because that is when we have a massive coupon expiration coming up, so mark your calendar for that. But let's get that out of the way and now focus on what we want to talk about in this video, which is number one, I've got to address inflation, because if you have a different belief about inflation, then you're not going to want to model yourself after this opinion. And of course, I can't give you personalized financial advice. This is just education to try to help you see, okay, how do I believe these perspectives fit into my investing thesis? Then I'm going to talk to you about what I think about investing in this time. I'm going to talk to you about what I think is happening in the market. Have we hit a bottom? And then of course, stocks and real estate in the portfolio. Okay, so the first thing that we really have to address is we have to understand this chart right here. Now, this is a little bit of a tricky one to really understand because it's just built on numbers that don't actually make sense to a lot of folks. So let's go ahead and set myself up. Actually, I like this size right here. There we go. We'll set myself up like this. Okay, so what this chart is actually just the raw CPI numbers chart. And that's very, very important because we get lost easily in the 9% figures and the 8% figures. And here's how inflation works. When we get an inflation read, what we actually get is a number. Like up here, we'll get a number and it'll come in at, let's say, 300. Let's make that very easy, right? And so if we are at 300 here and we look back at the last July, and we were sitting at a CPI read of 270 or maybe like 272-ish there, but just to make math simple, then we might look back and go, oh, that was a 9.8 or roughly 10% move in inflation, right? That's very important to know because in order for CPI to keep going, we have to actually see that CPI number continue to rise. So in order for us to get another 10% inflation set next July, we'd have to look back at this 300 over here and go, oh, wow, yeah, now we're at 330, right? And so that sort of rule of comparing to a high base makes inflation likely to go down solely on the nature of it's hard to kind of keep building on top of building. And there's a very fascinating thing that happened here. Take a look at this. This dip right here was the COVID dip. And so what happened was when we compared March and April low inflation data where prices actually came down or disinflated a lot into where we actually saw that base CPI number came down, when we compared to that in the spring and early summer of 2021, we saw a much more rapid increase in inflation because we were comparing to a whole, right? And so that was sort of the first impact that we had where we're like, okay, we're going to see greater inflation from base effects. Unfortunately, what ended up happening is we had problems on this end of the curve, which came after you saw this flattening of inflation in the summer of 2021, which was really incredible because here we were looking back past the hole now, and we're like, okay, now we're kind of back to moderating inflation. But the problem is this line over here really got propped up by multiple things. First, it got propped up by Delta, the destruction of supply chains, the hyper-stimulation via stimulus checks and child tax credits, PPP, bailout loans, money that often went directly into the stock market, right? Then we saw inflation really pump from Delta. Inflation continued to inflect higher. Probably the arrow pointing here is a little bit better because of the Delta variant, of the Omicron variant. And then, of course, we had the explosive war over here that pushed inflation to new highs. Now, my expectation is that inflation, after these three things play themselves out, will really have no choice but to moderate. This chart will slow down, and we'll see this relax towards the end of the year. Now, it could be entirely wrong, and that's why it's important to set this investment thesis up as my investment thesis is built on the idea that inflation will go down. It is propped up by 3 things that will end up being transitory in nature. And it was really propped up by 4 things, right? Original COVID, then you've got Omicron, then you've got Delta, then you've got Omicron, and then you've got war. And that these things will pump up inflation temporarily, this line here, and eventually they won't be supporting that line anymore, and it comes down, it flattens, which is the same thing that we saw happen in the summer of 2021 when inflation was starting to flatten, which was great. I think we'll go back to that. But it's not just a matter of what I think will happen. We have 2 people, or 2 groups of people, that actually agree with this substantially. One is the market. The market, via what are known as 5- and 10-year break-even yields, are expecting inflation to plummet. In fact, usually inflation expectations plummet about 2 to 3 months before CPI actually falls. Well, folks, inflation expectations have already plummeted. We are now at peak CPI numbers, but in 2 to 3 months, we can also see inflation plummet. So it's not just the fact that we're going to see that sort of hot air balloon of heat getting pumped up by these 3, 4 massive CPI pushing events go away. Those will become less of an impact. But we're already seeing the market expect inflation to come down. And the second one is we're seeing consumer expectations for inflation come down. Previously, they've been stable. Now they've actually started coming down, which is really, really good. And in addition to that, we're seeing commodities fall. And when commodities start falling, then we start seeing producer prices fall. And when producer prices fall, eventually, so then do consumer prices, which is very, very important. Okay, so why is it so critical to talk so much about inflation? Well, because if you believe that everything I just said is wrong, then you're going to want to have a different conclusion. If you believe that, Kevin, the line you showed us with the hot air balloon propping it up at those 4 different points, that is going to continue. We are going to see inflation continue because let's say the war in Ukraine is not over yet. We still have supply chain issues. That's fine. But when you look at shipping prices, commodity prices, energy prices, they're all already coming down. So just be careful if you think that inflation is going to continue to rage and continue the argument that that's it. We're going to have to get Paul Volckered. Well, folks, you probably are going to miss out on gains in this market. So that actually makes me bullish that this temporary inflation we're seeing is an opportunity to buy, and that we're still not seeing the characteristics that we really need to have to suggest that we will definitely get Paul Volckered. In fact, one of the reasons that I started rebuying in this market is because I realized we don't yet have the conditions, and they could come. We have to pay attention to them. There are always little red flags that pop up, and I pay attention to them daily. But we don't yet have the conditions for a wage price spiral. We do have broad-based inflation, but if that inflation only comes for shorter bursts of time, well, as we saw earlier, the line will mean when we hit the next cycle, that is in a year from now, and we're comparing back to these really high prices, these high CPI numbers, we shouldn't see those same ones again. Obviously, if inflation does end up proving to last in a broad-based manner, then we'll end up having to get Paul Volckered. But I expect, and we'll see, so do markets and so do consumers, that within the next 2 to let's say 4 months, we'll start to see what we actually call not inflation, but we actually call it disinflation. And this is where we start seeing the prices come down. So that'll reiterate the need for us not to get Paul Volckered. And the Fed has not expected or even expressed the attitude that we need to get Paul Volckered, although they've started to hint at their admiration for Paul Volcker, which definitely gives us reason for being concerned that, oh no, when the Fed starts hinting that Paul Volcker is a great person, he did great things, then you do start getting nervous a little bit. But fortunately, the data is siding with, we don't need Paul Volcker to wake up. All right, so this is sort of the baseline that you've got to understand, because then when you look at portfolio construction, you want to ask yourself, well, if inflation is high now, what do you want to do when inflation goes down? Well, when inflation goes down, we're going to expect that the Fed's rate action is going to come down. The pressure on them to continue to raise rates will come down. This is actually likely going to create a few opportunities. The first opportunity that I think it creates is we're going to see a real estate opportunity, because what you'll have is you'll have a lot of folks coming off peak mortgage rates, buying properties at in let's say less competitive environments, and potentially some softness in real estate pricing, whether that's from between 5% or 20% softness in pricing, really depends on your market and a whole host of other factors. But I do think once we start seeing the federal funds rate stabilize or come down, or expectations that it'll flatten, come down, or the expectations come in that the rates will come down, then I think there'll be an inflection point in real estate where we'll be coming off a season of less competitiveness and softer pricing, and I think there'll be a nice opportunity to buy real estate at slightly depressed prices, and we'll probably have that opportunity for 1 to 2 years, which I'm very excited about, which is why I will be launching a Series A that's all about investing in real estate. You can learn more about that by going to metkevin.com/Series A and learn more about it there once we have more information to share. It's going to be SaaS style / real estate company. And of course, the first people who will have the opportunity to invest for an exclusive 30-day period at the best pricing will be course members, which of course you can check out the link to courses linked down below. Okay, so real estate I think will be an opportunity. But also when inflation and real estate and rates that is come down, I do think we're also going to see a substantial opportunity in stocks. And it's specifically going to start, in my opinion, with a bottoming of tech, which we may already have seen, and then a return to risk on. I would just caution that if you see a return to risk on, like what we've seen in Bitcoin prices or even the NASDAQ, which I can show you graphically here, then you can be coaxed into getting into money-losing companies or profitless companies, sort of more immature companies. Money-losing companies aren't necessarily bad companies; they're just less mature companies. So a company, companies which I've sold at substantially higher valuations, because I said you don't want to go into a recession owning names like Affirm. You don't want to go into a car recession owning names like Shift. You don't want to own a money-losing company that's having trouble getting to profitability like Lemonade. I hate to say it, in a recessionary environment. You don't want to own a flipping company like Opendoor or Redfin in a recessionary environment. These are all the decisions that I talked about and made very, very clear on this channel back in January. I know some people are like, oh, Kevin, I can't believe you would paper hand those names. Well, I did, and I'm glad I did at much higher prices, because those aren't names that you want to hold going into a recession. But potentially, if the recession is now priced in and we get to a risk-on element, these names could actually do quite well. I mean, Redfin under $10 and the potential of real estate going through that soft patch and then rebounding, it's kind of interesting. You probably see some pretty outsized gains at some of the companies that I just mentioned if we get back to risk on. However, risk on always, and this is something you always want to remember, when you go into a risk on trade, you can't really buy and hold these. You have to watch those as companies that when the markets shift, you have to be willing to sell. Otherwise, you just bleed out and you end up down 70 to 90%, right? It doesn't make sense. For example, when Coinbase got banned in their opportunity to lend from the SEC, that was a big red flag, because even in my original analyses videos, I said any valuation that props up Coinbase relies on them switching to a layer 2 style of income. And if they can't do that, they're worthless. So you get problems here. So the problem with risk-on trades is that you have to trade them, right? And this is where I personally actually prefer tech stocks, like larger tech stocks and companies that I don't actually have to actively trade. I don't like actively trading because it's very, very difficult to actively time the market, though oftentimes you can do quite well. And what I like to do is I like to use a strategy that involves doing the opposite of what emotions are. And so, for example, if markets are booming, I like to trim. If markets are falling, I like to buy. And when markets are booming again, I like to sell. Now, I did this. If you go back and watch my videos, you'll see that in November when we peaked, I started trimming. I said, this is euphoric. I think this is unacceptable. I shorted ARK-K at $100. I really wish I held on to that short longer, but I held on to that short. Everybody in the comments got mad at me for that. How could I be such a fudster and short ARK? How could I bet against innovation? What an idiot. And comments really do get to me. It's problematic. I've really had a hard time the last 6 to 7 months, but that's not something that you care about. You care about the information, and that's fine, so we'll keep it to that. But anyway, I like trimming in times like these, taking a little 10% slice off, like Enphase or Matterport. And gosh, in hindsight, you look back and you're like, why take off 10% slices? Should dump the whole thing. Oh well, hindsight, right? And then what I really like doing is buying in these areas, in these troughs. And that's what I think we're in right now. And something that keeps a lot of pressure off of me is just every so often, as I close a property, I close a real estate sale, I get some extra money, I just buy. And that could be in a variety of different ways, and I'll tell you about that. That could be in a short position that I think is actually bullish to what I think is happening here, inflation coming down. I'll talk about that. It could be in DCAing into an M1 Finance pie, where I sort of have a basket of some of my favorite names that I think are going to do well. And we'll briefly touch on that as well. So I think this is an opportunity. But again, this here relies on not solely trying to trade. I understand some people say, oh, but Kevin, you sold everything. You know, you sold your portfolio in January, which wasn't necessarily at the top. It was probably more like here, and I probably rebought here. So this was November where I did some trimming. I'd probably say selling here, rebuying here, 20, 25% later, something like that for a lot of stocks. Hey, that's useful for covering capital gains. Maybe some stocks even lower. Some of them have gone down another 50, 60% from there. But some of those are not stocks that I want to re-own. Anyway, okay, so in order to do this, you've got, and I don't advocate kind of trying to, move a whole portfolio like that, but I do advocate dumping stocks that, in January that we knew are money losing in companies that are probably going to do quite well. And had you dumped those, you would have saved losses of 50 to 80% on some of these, right? Anyway, so if you believe the market and consumers are right, that inflation is going to go down, that the Fed is going to end up being right, that what I said is going to end up being true, that inflation will end up coming down, that there's just going to be a lag time between now where we're at peak inflation data and inflation actually coming down, then you're going to want to be ready to buy real estate relatively soon. You might potentially consider buying real estate, in my opinion, as soon as the end of Q3 and as early as probably as late as like Q4, Q1, but yeah, really as early as the end of Q3 could be a time to start really shopping again. And so that's what we're preparing for in that Series A. Now, tech, I really prefer because I don't feel the need to have to dump it when things really get tough because they're money losing and I'm uncertain about their survivability or whatever. And so the risk on trades, whether that's a crypto or, a more startup style company, you want to be careful here. Okay, now, what am I seeing in the actual charts briefly? And then let's talk about my portfolio and how it sort of fits into this and where's the, selling everything, right? Okay, so the first thing is take a look at this. This gives you a little bit of perspective on the weekly chart for the NASDAQ. You can see the weekly chart for the NASDAQ here has followed this pretty gnarly slope down here, and we've really bounced off that pretty dramatic declining chart here. But what we've noticed here is that even though we've capped out over here and we've kind of followed this trend and we've hit this triple cap over here, we're now at an opportunity to show that this trend can actually hold this break right here, because this is a break of trend. And if we can break above this trend line here for the NASDAQ on the weekly chart, I think there's the potential to say that the bottom is behind us. That is not necessarily guaranteed, but if the bottom is potentially behind us, it could make sense that we have a risk on or sort of recession relief rally that brings us into the territory of NASDAQ 338 to NASDAQ 378, this range. This would be a retracement of 50 to 78%. I don't believe that we really deserve to rally above the 78% line, and I probably would consider really hedging around the 61 to 78% line, and you could write that in as consider hedging between 354 and 378, and maybe even consider going as far as selling above that 378 figure. But I do believe if we break here, we have the room for a nice rally, which will be very gratefully received by many of us. Now, there's always the possibility that it looks like March, which is over here, which March was really just the beginning of a further and larger downtrend. So we have to be careful about this. And you could see what happened over here. Well, actually, we don't have the Fibonacci up for this, but we just remember that when we compared the Fibonacci from here to here, we did retrace over 50%. We did retrace over 61.8%. And that's when we started saying, hey, careful, we really shouldn't be running like this yet. We're not even close to inflation going down yet. And sure enough, we ended up having more bottoms. Now, that doesn't mean that I've been perfect with my portfolio. I absolutely have not been perfect with my portfolio, but I've done what I think is best. And that was in January, selling everything to get rid of any kind of money-losing company, any high-risk company. I was able to sell everything. And that included my tech, that included my crypto, that included my risk on. Now, I did trade into some crypto after that, and unfortunately had some losses on ADA, but that was a fraction of my previous position. I just want to make that very clear. Again, not perfect when I say I sold all my crypto in January, but I did sell all my crypto in January. I just rebought and then sold again a little after that. But anyway, I'm glad I got rid of all my risk on, and I really haven't exposed myself to a lot of risk on yet. Risk on probably represents maybe 1 to 2% of my portfolio. You can't really see that there, so I'm going to write it over here. Risk on probably represents somewhere around 1 to 2% of my portfolio for risk on. Not super jazzed about going into this, even though I think this is where larger tendies could be. Now, if you really want to play those larger tendies or sort of upside hedge, one of the things that you could do is you could kind of go for like YOLO calls, but look for companies that have low implied volatility. Like I mentioned, Tesla, although Tesla's not really a risk-on play, Tesla's more of a tech play. But you can find companies with low volatility right now. Tesla did have low volatility right before earnings, which is weird that they had low IV right before earnings. But anyway, YOLO calls can be cheap then on these, and I call them upside hedge protection. They're kind of like YOLO calls that you make expecting to lose money. You put in like 0.5% or 0.1% or up to 1 to 2% or whatever on YOLO calls, and you do that to sort of prevent FOMO from getting to your entire portfolio. Because like the last thing you want to do is, let's look at a company like a firm, which is quite risky if we have to continue to see allowance for doubtful accounts increase, unless of course the recession bottoms and this is a great risk on play. Going all in on a firm might be quite risky. But if volatility is low and you take 1% and you go for a YOLO out of the money call, and you can see a substantial amount of upside in this if it rallies, well, now you don't feel bad that you didn't go all in on your portfolio, but now you also didn't expose yourself to that much risk, right? So that's what I consider an upside hedge. Again, YOLO calls, you want to look for these when implied volatility is low. And then when we get to higher levels on the Fibonacci, that's even sometimes where you can get hedge protection like YOLO puts. But again, these risk-on kind of plays should be a low portion of your portfolio, and they have been. The biggest name in terms of a risk-on position that I've gotten back into around this $4 range is Matterport, whether through shares or sold puts or whatever. That's probably one of the biggest that I've gotten back into. But I'm also considering, honestly, things like, especially after the dips that we've seen over the last couple days, things like Carnival or Play or Win or Etsy. Although some of these are more, I would say these right here are your risk on. These are more sort of the consumer staying strong or coming back plays that I feel like could be a little weak right now. But these are trades that I'm keeping as smaller portions of my portfolio because they're not necessarily companies that I need to see in my long-term kind of portfolio forever. Instead, what I have been using all of this dip time as an opportunity to do is really build out my tech position more. And my tech position mostly consists of Tesla. I have over 25,000 shares of Tesla. I'm really trying to get, I've got a personal goal of trying to get to 30K shares of Tesla. I'm not there yet. We've had some increases in the pricing here, so it just makes it harder to get there. I don't necessarily need to do that though, because I'd rather spend a little bit of time diversifying into my M1 pie. Now, my M1 pie, the exact proportion is linked for course members, but it gives you, just to give you an idea, it includes some of the travel recovery plays, whether that's the Etsy, the Win I talked about, but it also includes really my favorite and core tech names. Now, even though I really think that, or have been thinking that homeowners would stop spending as much money on solar in a recession, if we actually don't end up seeing that real estate softness, Enphase is a phenomenal company and it's a great play. I'd love to buy it weaker, but rather than try to perfectly time Enphase, I sold most of my Enphase at 196, which I bought at like 120. Oh well, I know it's at like 215 now. It kind of makes you look back and go, dang, should have held, but hey, you know what? Oh well. So what I'm doing with my M1 pie is I'm diversifying between companies like Enphase, NVIDIA, and even like Visa's in here, Tesla, but sort of my larger core position is going to be tech, which will include Apple, even Microsoft, plays like that, my core tech plays. And the reason I find my core tech plays to be so critical is because these are companies that I don't really feel obligated to dump during tough times. And although I made a trade in January, got back in March and April, and the end of February, these are not trades that I ever really feel like I have to be concerned about, where in 10 years, do I really think I'm going to look back at Tesla, Enphase, and Nvidia and go, oh darn, wish I sold those because they ended up losing money? Probably not. Apple, Microsoft, right? These are not companies I'm really worried about in the next 10 years. So you can kind of set and forget them. That's unlike, remember, a company like that's very risk on, like a Lemonade or Shift or a Firm, where if you set it and forget it, you can really get burned. Those are not set and forget kinds of plays because they're emerging companies. They're very risk on companies. So I've really been building my portfolio here with the Tesla, the Enphase, the Nvidia. And now, since prices are starting to kind of rotate up a little bit, I've got a good position in Tesla, really diversifying into this M1 trade. And that gives me an opportunity to just sort of diversify again. But the next thing that I'm also doing is I'm shorting the dollar. I've been buying UDN as soon as the dollar broke parity with the euro. That is, the euro fell under a dollar, which was quite remarkable. I bought a large short position, and I'm going to keep adding to this as we kind of move. I'm DCAing into this a little bit here. Although when I say DCA, it implies it's been going down. It's only been going up since I've been buying it. That is, my position has been going up since I've been buying it, which is great. And I kind of expect it to continue to, but I'm not going to keep buying it. I'm not going to like follow this thing up. But if it does, if the dollar strengthens, I'll increase the size of this position. If the dollar weakens, I'll increase the size of this position a little bit more, but I'm not going to go too crazy on this, although I'm already into this for a few six figures, and I'm interested in getting it, making my position a little larger here. So what this is, again, is it's shorting the dollar. You buy UDN, it's an inverse dollar ETF, you're shorting the dollar. It's an expectation that the dollar is probably going to weaken, the euro will strengthen, and really what this is an expectation of is inflation being transitory. As inflation goes down, our bond yields go down, which puts less pressure and desirability on our US bonds, which creates less pressure on people buying the dollar, which means the dollar can actually weaken. Now, some people are like, oh my gosh, isn't that betting against America? No, it's betting on inflation going down, which in my opinion is allowing me to really have outsized bets on betting on America. So why do I say I'm selling everything? Well, or that I have sold everything? Well, it's because I sold all my real estate that I wanted to. I think this is quite remarkable, but I finished. I've gone from 27 SoCal properties, a portfolio worth somewhere in the neighborhood of $24 million, down to 5. Now, obviously, this was leveraged, right? It was somewhere around 55% debt. Obviously, there are going to be some long-term capital gains implications to this. But the big reason for making this transition is twofolded. Number one, I did not want to go into margin to pay taxes. I had an opportunity to buy a really big asset at the end of last year, but I thought it would be terrible in a recession, which didn't know we were going to go into a recession. Glad I didn't do that. Would have given me a lot of tax write-offs, but I think it would have been a terrible idea in a recession. So I had to pay my taxes. I had to pay over $10 million in taxes, which is quite insane. But hey, you know what? When you have a really good year like 2020 or 2021, you pay your taxes, so you have to pay your dues. I also paid off every dime of margin I have, so I have absolutely zero margin. And what I've really been trying to focus on doing is taking my money and building my portfolio mostly in tech and plays that I think will do well when inflation goes down. So I'd say I'm probably 85, I'll say I'm about 80% in tech, maybe 2% over here on the dollar short, and this is just rough off the top of my head, maybe 1% on the M1, which I really want to build this up to, like, say 5 to 10%. And then I've got some cash, and then obviously the leftover properties that I have, which are either under construction or the house that I bought for my dad that I own, or the properties that I'm using for living in and for work. For example, I was considering signing a commercial office lease for our new Series A that we've got coming up, but I really decided that I want to wait for softness in the commercial leasing space, because if the real estate market does slow down, I don't want to lock in a really, really expensive lease. So I'm going to hold off on that, and I'm going to use a property and convert that to an office rather than selling that property, because it's something I already have, and it makes a lot more sense money-wise. So I sold this real estate for, number one, reason, taxes. Number two, getting out of margin, but then also preparing for that Series A opportunity. I want to have money, as much money as possible for that Series A opportunity, because I want to throw a bunch of money into it too and invest alongside either you or course members or whatever at the best valuation that we possibly can, which will probably be just a 1-to-1 valuation. Like, my money will be worth what your money is worth. But this is not designed to be a solicitation, so I don't want to confuse anyone, certainly not the SEC. So These are just some thoughts that are going through my mind. It's not a solicitation for you to invest with this. So where do I position myself from here? Like why am I going into tech? Why am I selling real estate and going into tech? Well, let me make that clear. To me, it's sort of a real estate cycle play. And the idea is if I get rid of my obligations for taxes and margin, which I've done, never been margin called, which is great. What happens then? Well, I'm throwing money into tech, which unfortunately has kind of been this like furnace, this fireplace. It's really felt like, wow, I sell a property, I throw it into tech, and then it's like I lose all that money. And it has felt very, very bad. Going through March, April, May. May was probably the bottom of the market. June, these have been rough times. Now we've had some little, weak rally here. The last week has been phenomenal, which is great, which finally makes me a little happier again because I hope the market is seeing that, yeah, inflation will end up being transitory. I'm glad I sold everything. I wish I waited maybe an extra month or two to really go heavy back into the market, but hey, can't do that. I think I made a good move, and now I'm sitting in tech and I'm taking money from real estate and throwing it into tech or that UDN short of the M1 pie. And what's great about that is I really believe this, and I could be wrong, but what I really believe is the stock market has done this. I think we're either here or we're at sort of close to a turn, and I don't know how quickly that'll go up. It could be very slow, like a longer U-shaped recovery, right? But I definitely think we're somewhere along the bottom. I think the bottom ended up being 268 for the QQQ. We're sitting at like 310 right now, so maybe that's like right over here. And for me, this has just been buy time right here. As I said, I've done and will do, and what I teach is you buy when there's pain. You buy when there's blood on the streets. That's what I've been doing. Unfortunately, you get your hands bloody too. Everybody's like, you're catching a falling knife, whatever. But I think that as we see the stock market rebound, and let's say we're here, 50%, oh, you can't see that. Let's say we go back up to, here. It's a 50% retracement, there we go, to what we mentioned on the chart earlier. Let's say we go back to here. I think at this time, we're probably also going to have seen real estate do something like this. Not necessarily a giant kind of crash, but we'll be at that intersection where I'll have thrown money into the biggest pain point in the stock market, hopefully ridden that up to whatever the softest point is we get in real estate, whether that's minus 5% in prices or it's minus 28% in prices. I think there'll be an intersection of those because real estate's so slow and it's really lagging behind the stock market right now. And it's going to give me the most capital possible to buy real estate and to invest in this Series A that I've got coming up. Again, it's going to be real estate meets SaaS, software as a service, and it's going to be really, really, really exciting. That is going to be my life's goal. So when I say like selling everything and I sold all my real estate, it's true, I sold all my real estate. With the exception of those 5 core properties I'm keeping. And it's really to go into something what I think is like, this is my dream. And I never really talk about my dreams on this channel. People are always like, oh, what's your number? Like, when are you going to retire, right? This is it. Like, my dream is to build something for my children, to build a company that my children can work for if they want to build equity in a company that's mine and not just other people's companies in the stock market. And my goal is to really see something that I could take from, let's say, I don't know, $50 million and turn it into a $500 million company. Can we then turn that into a $5 billion company before I die, right? That's my dream. That's my goal. So if people are wondering, like, what's my goal? It's that. And I really admire, by the way, these people are like, oh, well, how are you going to get paid for this or whatever? And my thought is I really want to pull an Elon strategy where I take zero salary. Like, if the company doesn't make money, we don't make money. There's no like dilution day one. It's like we invest 1-to-1 in this deal, right? That's my vision and my dream. And that at some point in the future, then if I can, take the valuation from $50 million to $200 million after an IPO. Like, I want to IPO this thing. That's my dream. I want to ring the bell with this company. Well, then maybe there are like some stock options or whatever. That's sort of my thesis, is like, I make money when we on doubles or quadruples, right? So that's my dream, and I don't want this to be like a kind of like a crazy like valuation where it's like a meme stock or something like that. I really want to build this as something that's like, my admiration would be like a Warren Buffett, Berkshire Hathaway style, just slow and steady. You know what you want to do. You've got the time horizon to do it, got the skills to do it in real estate and the plans and the know-how. I'm excited. So that's another reason that I sold a lot of my real estate, is to really go into that. And I know some people are like, why would you sell real estate to go into real estate? Well, because it's going from personal real estate into company real estate, and this business opportunity and building out the SaaS biz, whatever, right? So anyway, okay, there's a complete update and all my thesis in just a straight up chat time, you and me. I hope you liked it. If you like these kind of discussions, I like doing things like this with my course members as well. I don't know if people on YouTube like this versus like all the charts and the data and just give me the news, give me the info. But I just thought I owed you a one-to-one, and here it is. Thanks for watching. Goodbye.